Good. Now, when we talk about topic number 10, standard costing and variances. So normally, companies have their standard cost card. This standard cost card will be indicating the amounts that they normally incur to do production of a given product. That is their standard cost card. So if you want maybe 10,000, you want 5,000 units, then basically take what they have there as the selling price and multiply by the quantity you want to buy from them. So in reference to what you have just done, that particular question, if you look at its standard cost card, they were giving us direct material, giving us direct labor, variable production overhead, fixed production overhead. So once you add all these costs, right? Once you add all these costs, you're able to see they're giving us standard production cost. To the standard production cost, they can now set their profit markup, right? So the company come here and take standard or profit markup. Let's say it is 5%, right? So they add the profit markup of 5 or even 25%. Once it is added to this, what they will be getting is the standard selling price. So any profits will actually be taken care of by looking at it. So if we are going to have fixed and production costs, if we are going to have variable and production expenses, then this item will be the savior. This item will be the savior volume or output. As the volume increases, they're going to increase their net profit, right? And that net profit should be sufficient enough to cover, number one, fixed non-production costs, and of course, variable non-production costs. That's what we'll be having. Now, a company will be having its standard cost cards, and they say for them to be able to come up with these standard cost cards, their budgeted activity level were as follows. They talked about budgeted volume of output being 150,000 units, right? So this standard cost card was arrived at by taking the cumulative amount in card dividing by the volume of output to give them cost per unit. But now, if you go to the actual production, then what I'm going to do, we'll be able to see again actual expenses under each category, right? So once we get the actual expenses under each category, we'll compare it with the standard cost given here. So the differences might be, number one, due to indirect material, talk about units purchased and the purchasing price, right? So the two will give rise to two variances, which when added together will give us material cost variance. The same to direct labor, the same to variable production overhead. So I want us to, because we don't have time for all these stories, right? We don't have time for all these stories, and we have the point. We want to be straight to the point. So as you open, let's just have November 2015, question number 4B. So as we do that question, we'll be explaining every single formula. So let's get that question ready. Let's have that question ready with us. Variances is about the formula. Variances is about the formula. Once you have the formula, everything will fall in place. So let's have, is it November 2015? So see here. 2015, question number 4. Oh. November 2015, question number 4. November 2015. Not pilot paper, November 2015. Question number 4. Question number 4, let me confirm. Yes, it should be November 2015, question number 4B. November 2015, question number 4B, CPA past paper. CPA past paper, November 2015. November 2015. Have you been able to access the paper? Have you been able to access the paper? November 2015, question number 4. Question number 4. November 2015, question number 4. Question number 4B. Question number 4. November 2015, question number 4B. Good. So I think I'll be able to access it here. November 2015, question number 4B. Question number 4B. Good. So, showing applicable variances, prepare statement that reconciles the budgeted contribution with the actual contribution for the month of October 2015. Good, so I want to get the contributions, then get the reconciliation statement. So we're talking about, what's the name of the company? Q Limited manufactures a single product branded Q. The standard selling price and variable cost per unit of Q are as follows. So we have selling price per unit, 136. Material is given as 2 kgs at 10 shillings per kilogram, right? So the cost of 1 kg of material is 10 shillings. But for us to produce a unit of Q, we need 2 kgs. That is why standard cost per unit of Q is equal to 20 and direct material. Then labor, 3 hours at 24 hours or 24 shillings per hour. We are talking about 72 shillings, which means they utilized 3 hours. They utilized 3 hours, but the rate per hour is equal to 24. Additional information, the budgeted sales for the month of October 2015 were 38,000 units, right? Actual results for the month of October 2015 were as follows. Production and sales, 36,000. So they budgeted 38, they're actually producing 36. Selling price per unit is now 134, not 136 as per the budget. Materials used 76,000 kilograms, right? And of course we have 754,000. Then labor, we have 114 hours paid. The company operates a standard costing system and just-in-time purchasing and production system. So the word just-in-time, basically means just-in-time basically means there is no opening and closing stock. Anytime you're going to need just-in-time inventory management system, the moment you'll be able to see a company applying just-in-time inventory management system, they are basically trying to tell you the company does not have warehouse for closing stock. The company does not have warehouse for closing stock. They only purchase what will be sold, so they don't stock anything in their warehouse. They don't stock anything in their warehouse. Good. So having done that, having read the question, I want us now to look at some of these things. The major items. For us to come up with the compensation statement, we must deal with sales part, right? And the contribution, right? So we are given selling price. Are we given budgeted sales in quantity? Yes. Are we given budgeted selling price? Yes, that is given to us. So if you look at what we have done, the other question, you were able to get cumulative sales variances. At this particular point, we want to look at the individual items. Is this variance due to difference in units sold, or is it due to difference in selling price? So we are going to start with the first formula. If you know these formulas, you don't even need to read anything about topic number 10. If you'll be able to master these formulas. So the selling price variance is equal to standard price minus actual price times actual quantity sold. That is what you need. Selling price variance is equal to standard price minus actual price times actual quantity sold. So what will we given as the standard selling price? We pick it from the standard cost card. So how much was it? Standard selling price. 136, right? So the standard selling price is equal to 136 minus actual selling price. What was the actual selling price? We get it from information number 2. Actual results for the month of October were as follows. 134. Remember, we are looking at the variance in terms of selling price. So before you even move beyond this particular point, what will you advise these people? Is it adverse or favorable? As per the standard, they say each unit will be sold at 136. They ended up selling each at 134. Is it a lost revenue or a gained revenue? They have actually lost some amount, right? They have lost some amount. So whether you're going to get a positive figure here, your interpretation is it will be adverse. Anything that is coming after that, those are stories, right? So let's come to this part. Actual quantity. How many units were actually sold? How many units were actually sold? How many units were actually sold? What is it? Additional information number 2. Production and sales. 36,000. Good. So please go ahead and give me sales price variance. So the selling price variance, what did it give us as the variance? The difference here is 2. 2 by 36,000, 72,000. 72,000. So indicating whether it's adverse or bad, favorable, you are to identify it at this point before even you move to bring in what is outside the bracket. So we say it is adverse because they receive less revenue. So we have sales margin. We have what we call sales margin volume variance. Sales margin volume variance. So sales margin volume variance is equal to standard volume or budgeted volume minus actual, standard quantity minus actual quantity. Then we multiply by standard contribution. Someone is lost. Sales margin volume variance. Volume. We would have indicated sales margin quantity variance, but the word volume makes it appear more presentable. We talk about volume, we're talking about quantity that has been sold. Good. Now the part that will be challenging, or maybe someone will be bringing, we'll be having some challenges on the standard contribution margin. So the contribution margin, you must understand these terms in management accounting. How do you normally get contribution? Contribution is equal to selling price of sales minus variable production cost. The variable production cost we are talking about here is direct material, right? Is direct labor variable production overhead, right? Variable production overheads. Good. So let's come to this part. It is standard contribution margin, right? So contribution is equal to sales. What was the selling price per unit of Q? 130, 136, right? 136. 136 minus. So number one, we start with direct material. What was the cost of direct material required to produce 1 unit of Q? What was the cost of direct material required to produce 1 unit of Q? What was the cost? What was the cost? Let's see if this is actually what we are doing. Tuchangamke, what was the cost? Yes, that's what I was waiting for. What was the cost? What was the cost? What was the cost? What was the cost? Now let's see what is given there. Material, they require 2 kgs to produce 1 unit of Q. 2 kgs to produce 1 unit of Q. But now, 1 kg is equal to 10 shillings. So if I want 2 kgs, how much will I spend? It is 2 kg times 10 shillings, which will give us 20 shillings. So that's how they got the 20 shillings at the cost of direct material. How about direct labor? How about direct labor? How about direct labor? How about direct labor? We have said 2 kgs was utilized to produce 1 unit of Q. 1 kg of this material is 10 shillings, and they utilize 2 kg. So it is 2 times 10 giving us 20, right? So that's what we bring here. Under direct labor, how much was spent? So labor, where they need 3 hours, but each hour is 24 shillings, right? So when you take 24 by 3, it gave us 72. So what are we bringing here? We are bringing in 72. Do we have variable production overhead given in the question? Do we have variable production overhead? No. If it was there, we would have added it here. But because we don't have it, this is what will give us. This is what will give us contribution. So 136 minus 20 plus 72. That is 136 minus 92. What are you getting? 136 minus 92. 44. It is about the camera. So let's look at that camera. Let's look at the camera. Let's look at the camera. Camera is letting us down. Camera is letting us down. Let me just see if I can get now proceed. We can now proceed. We can now proceed. So we are getting 44. Remember, I've said if we add variable production overhead, then we would have added it to this 72 to be able to get total variable production cost. So once you add the two, you'll be able to get the production cost deducted from sales, right? What have we said? Not any other contribution margin. It is standard contribution margin. So all these figures are being extracted from the standard cost card. So when you deduct 40, this one here we have 44, right? So that's what we're going to utilize here. Let's come to this other part. Do we have standard quantity? Standard quantity, what they were anticipating to sell. Do we have that? Standard quantity. Standard quantity. How many units? How many units did they intend for? Yes, the intended, the budgeted sales. So information number one, budgeted sales for the month of October was equivalent to 38,000. Good. How many units were actually sold? How many units were actually sold? How many units did they actually sell? So what can you tell us about this difference? If what they intended to sell is less than what they have, is more than what they have actually sold, what can you tell them about this difference? Is this something they should be laughing about? It is not a laughing matter, right? They should be able to take it with a lot of seriousness and see what happens. So you multiply by standard contribution. We already know it is adverse. So what is that adverse? The difference between these two is 2,000 by 44. What are you getting? 2,000 by 44? 88,000. 88,000 adverse. 88,000 adverse. Good. So that is the selling part, the sales. So if you are told to give us, if you can recall, you are able to see we are getting what we call sales variance. So how are we getting the sales variance? What they did, they were getting the cumulative amount. The variance due to selling price, which is 72,000 adverse. The variance due to quantity or sales volume, 88,000 adverse. So the total sales variance, if you are told to give us total sales variance, what will you have? Is it 160? Is it 160,000? 160,000? 160,000 adverse. 160,000 adverse. If you are told to give us sales variance, right? But of course, that is not required at this point. So the next variance we're supposed to deal with, what I want you to master very extensively is the formulas. These formulas will help you solve anything under variances. We are done with the sales. Let's go to the cost now. The first item is material. We start with material price variance. So material price variance is equal to standard price minus actual price. We are comparing the prices. Then you multiply by actual quantity sold. Purchased. Actual quantity purchased. Actual quantity purchased. Material price variance. Material price variance. Good. Now, are you able to give me the standard price for them to be able to purchase material? What was the cost per kg of this material? What was the cost per kg of this material? Cost per kg of material. If you look at the standard cost card, we are told that material utilized is 2 kgs at 10 shillings per kg. So you bring in the 10 shillings per kg minus actual price. Actual price. Are we able to get actual price per kg of raw material? Actual price per kg of material. Actual price per kg of material. Good. Another thing that I need to explain under that point. Now, this is what will happen. In exams, in most cases, you're going to get such a result. So what have you done to be able to get 9.92? You've taken 754, right? Divided it by 76,000, right? This one here, that is for you to be able to get actual price. Then once you close your bracket, you'll be multiplying it by actual quantity again. You will be multiplying it by actual quantity. So I want you to see this difference, how it will be coming in. Very interesting. So when you take 10 minus 9.92, I want to use this person one rounded off to 2 decimal. Yes, then you multiply by 76,000. What are you getting? Please give me the answer for this one here. I want the rounded off one because we are not going to get that 6,000 or 60. We'll have to do that happen. Close to 6,000, but not. 60, 80. 60, 80. That is someone who has rounded off. Now that we've been able to understand this part, that when I take 754,000 divided by 76,000, it is giving me 9.92. But without rounding off that, when I multiply by the same thing, look at it. Where will I get to? I'll get back to 74. So it is very simple. Just take 76,000 times 10 minus 754. What will you have if you don't round off? If you don't round off, what will you have? In short, I'm discouraging rounding off when doing variances. Let me be clear. I'm discouraging rounding off when dealing with variances. Because at this point, this one here divided by this, I'm going to get a whole number without any decimal places. But if I divide it fast, somebody round off with decimal places 3, which will end up giving you 60, 80. Right? So avoid rounding off. So once you avoid rounding off, of course, we're able to see the anticipated purchasing price was 10 shillings. They ended up purchasing them at 9.92. What happened? It is actually favorable because material involves cash outflow. And if we can get something which is reducing this cash outflow, we must be more than happy about it. So we are talking about 6,000 favorable. This time around, anything we get positive, it will be favorable until we get to the fixed overhead volume variance. Great. Then we come to the next thing. So under material cost, we are dealing with the material price. The variance can be due to the prices, the difference in prices, or difference in quantity. So material usage variance is equal to standard quantity in actual production minus actual quantity. Then you multiply by the standard price. Standard quantity in actual production minus actual quantity multiplied by standard price. Can someone give me standard quantity? How many kgs of raw material were needed to produce 1 unit of Q? How many kgs of raw material were needed to produce 1 unit of Q? Where are we getting that? From the table up there, material 2 kgs at 10 shillings per kilogram, giving us 20 shillings to be able to produce 1 unit of Q. So at this point, we are talking about how effective are you utilizing the raw material. So we need 2 kgs of material to produce 1 unit of Q. But we are being told it is standard quantity in actual production. So what was the actual production of my product Q? Actual production of product Q. How many units of Q were actually produced? Information number 2. People are letting me down. People are letting me down. They actually produced what? 36,000. So that is what we have as standard quantity in actual production. Then we less or we compare with actual quantity. Actual quantity of raw material. So how many kgs of raw material were actually utilized? How many kgs of raw material were actually utilized? Anytime you hear me mention the word actual, for this particular question, run to additional information number 2. 76,000. Compare that with, or multiply by the standard price. Standard price, you already used it up here. It is listed. So when you take 36,000 by 2, you are getting 72,000. They budgeted to utilize 72,000 kgs. They ended up using 76,000. What will you tell this company? Is it something they should be happy about? Is it something they should be happy about? When you plan to spend 72 kgs, you ended up spending 76. So 72 minus 76 is a negative of 4,000, right? It is adverse. So the negative, once you get the difference there, multiply by this. So what are you getting? What are you getting? What are you getting? Is it 40,000? Is it 40,000 adverse? 40,000? 40,000 adverse. 40,000. 40,000 adverse. Good. The next thing, we need to look at labor. So we have been able to look at material in terms of difference in price and difference in quantity utilized. So that will give us material cost variance. So if you're told to give us material cost variance, you take price variance plus usage variance. This time round, price has got positive, usage has got negative. So it is basically positive 6,000 minus 40,000. Or the difference between these two. The net amount, in short, the net amount. So that will be 34,000 adverse. So let's come to labor. So under labor, we talk about labor rate variance. We don't buy labor, we pay for the services. So labor rate variance is equal to standard rate, not standard price, right? It is basically this formula, but you don't purchase labor. So you cannot talk about standard price. We're talking about standard rate minus actual rate. Then, because we only pay for the labor hours, we talk about actual hours. That is the right term. So are we given standard rate per hour? Labor rate per hour, standard labor rate per hour. Go to the standard cost card and tell me the figure. What is the labor rate per hour? 24 shillings. Actual rate ni ngapi? We go to labor, we are told 114,000 hours were paid at what price? 26,56,000. So for us to be able to get actual rate, you take actual amount paid, we divide by actual hours. It will give us actual rate. Then we multiply by actual hours, which is 114. What did I say? Under variances, we don't round off. But of course, we've given us that to be able to compare 24 and 23.3.298. So if you budgeted to pay 24 and you ended up paying 23, you've actually saved, right? You've actually saved. And because you've saved, it will be favorable. So now forget about the rounding up and get back to the entire thing. So this divided by this, and this will take us back to 2656, right? So just take 114,000 by 24 minus this one. What are you getting? 24,000 multiplied by what's out the bracket. Then you less this. What are you having? 80,000. 80,000 favorable. 80,000 favorable. You spent less. Good. Then, once we look at the labor rates, how about efficiency? How effective are you utilizing this labor? Or you have this kind of employees that normally take 3 hours before they do the actual work. You pay them for 8 hours, they take 3 hours greeting everyone, and of course, going for lunch break, and only work for 5 hours. So labor efficiency variance. Labor efficiency variance, we could have talked about material usage, but we cannot talk about usage. We are talking about how efficient are you utilizing this labor, right? So that's why we talk about labor efficiency variance. So it is standard hours in actual production minus actual hours. Then you multiply by standard rate. Standard hours in actual production minus actual hours, then you multiply by standard rate. So if I look at this question, I'm able to see standard hours per unit. If you are keen enough, you'll be able to see some. So the standard hours as actual production. How many hours do we need to produce a unit of fuel? We need 3 hours, right? We need 3 hours. Then how many units of Q were actually produced? That is how much. Then we compare that with actual labor hours. Here we have actual hours. This one here. We multiply by standard rate, which we already used. 24. So can you just take 3 by 36,000? What are you getting? 3 by 36,000. What are you getting? So that you can compare the two. 3 by 36, 108. So you planned to spend 108. You ended up utilizing 114,000 labor hours. Is it adverse or favorable? Is it adverse or favorable? It is adverse, right? So what is the figure? Take 108 minus 114, that will give us 6. 6,000 by 24. What are you getting? 6,000 by 24. 6,000 by 24. 114. 114,000 adverse. 114,000 adverse. So that's what you are given in that particular question. That's what you're given in that particular question, the variance. So in our next class, we'll be looking at variable overhead, fixed overhead variances, right? Fixed overhead, 144, not 144. Thank you, 144. 144. Now, if you are told to prepare a reconciliation statement, can you do that? Because we are required to come up with the applicable variances, prepare statement, and reconcile. Because of time, I will not be able to reconcile it. But I want you to go during your free time between now and Friday to prepare for me number one. Number one, budgeted income statement. Number two, actual income statement. So that when we meet on Friday, we are going to do reconciliation. Or you can actually do it. Reconciliation statement, right? You basically give us budgeted statements because I've given you the procedure. 144, not 114. I think I've indicated 144. How much should I go up? Where's the problem? Oh, it is okay, good. Now, we did it actually the other question. You first of all we got our budgeted. So in this case, we have up to contributions. We have budgeted contribution, right? Then to this budgeted contribution, you need to adjust the variances, right? So under variances, you come and give us selling price variance, sales margin, volume variance, material price variance, material usage variance, labor rate variance, labor efficiency variance. Then you give us the variances there. You copy this, put it here, put it here, put it here, put it here, put it here. And of course, you add budgeted contribution. So when you add all of that, whatever you are getting here must be equal to your actual contribution. Must be equal to your actual contribution. So what I've given out is that you want to do budgeted income statement, actual income statement. So that when we meet on Friday, we'll be coming up with a reconciliation statement and almost forgetting about topic number 10. And almost forgetting about topic number 10. Thanks for your time. Have a blessed night and let's meet on Friday.